Hi, and welcome to another great segment on accounting and tax, everybody's favorite topic. My name is Greg Freeman. I'm going to be speaking to you today about the self-employment tax. So what is the self-employment tax and who does it really apply to? That's always a very common question for those that are entrepreneurial in spirit and are starting to get into their business and branching out. Maybe they're doing consulting. Maybe they just decided to open up a brick and mortar restaurant. That's basically self-employment. You become employed by yourself. But what does it mean for tax purposes? Because this is going to be a major shift for a lot of people. When people get into business, they want to understand exactly how their taxation, how their taxes are going to pan out come filing time. So this is always a great opportunity for those that are just getting into business and branching out to seek the help of either a certified public accountant or an IRS enrolled agent that specializes in taxation. So let's talk a little bit about what the self-employment tax is, how it's calculated, what you need to know, what are some of the pitfalls, and just in general, how we can minimize the self-employment tax. What are some great tips and strategies that can be implemented to avoid getting really slammed with taxes? Because guess what? When you do become self-employed, you get a lot of perks for being in business from a tax perspective, but there's also going to be a lot of additional new taxes. Why? Well, as the name implies, you're self-employed. So if you're self-employed, you're basically seen as both the employer and the employee. That's right. So the tax law now sees you as wearing two hats. You're all of a sudden the boss, and all of a sudden you're the employee. So how does it typically work when you are just a regular employee and you don't have both sides on you, right? So how does it typically work? So when you're working on a W-2 and you're just an employee of somebody, you're basically getting a paycheck, and you probably have noticed on your paycheck different levels of taxes being deducted to get to your net pay. So part of those taxes is the Social Security and the Medicare tax, or what we call the FICA tax, okay? And that's 6.2% for the Social Security and 1.45% for Medicare to get to a combined percent of 765. Now, when you're an employer, what you don't see is that there's 765% being paid on your behalf as the employee, okay? So when you're getting your net pay, you don't actually see your employer's contribution towards your Social Security and Medicare. That's something that's obviously not going to be on your pay slip, but your employer is matching the same amount that you're paying towards your Social Security and Medicare tax. That's basically what's happening behind the scenes. So if you're all of a sudden an employer and employee, you now have to pick up 15.30% as both employer and employee, and that could really add up to a lot of money for some people. Just think about it. If you've made $100,000 in profits as a self-employed entrepreneur, that would basically spell out to be $15,300. That's an oversimplification, because that's not, I'm going to jump into some of the mechanics so that you understand how the tax is calculated and what it really is effectively. But believe it or not, yes, this is pretty much the actual amount of taxes that you're going to see being calculated on your return, and you will be responsible for this on top of the income tax. So the income tax, and that holds true for federal, state, and local income taxes. On top of those taxes, you're going to have to pay also self-employment tax. So that kind of brings me to a quick point that Uncle Sam and the government agencies, they're, you know, at the end of the day, they take out so many levels of taxes from your income that in a way you're basically partners with them on a 50-50 basis, because between the income tax, the Social Security and Medicare taxes, you have the state income tax, and if you're in a city that taxes like New York City, you have also an additional layer called the local tax. And so when you add all those up, if you're making a decent amount of money, and you don't have to be a millionaire, you can be your average earner, somebody that's making from 200,000 to 400,000 possibly, you're basically giving over, could be easily over 50% of your income to tax. So that's basically how it works. Now let's talk real quick about the Social Security cap. So I guess your question would be, well, can they tax me indefinitely? Does it ever stop? And yes, it does. Social Security has a cap for 2023. The Social Security cap is $160,200, and every year this number keeps growing, indexed for inflation, which means that every single year the Social Security Administration is getting more and more and more of this tax, because I can remember when this number was under $100,000 back in the day, and every single year they raise it, and there's really no rhyme or reason as to how much they're gonna bump it up, but this has really doubled. I'm sorry, this didn't double, it went up by like $30,000 almost from the last year. So that's a huge increase. That means that they're just getting a lot more of the tax. But nevertheless, there is a cap. So once you've earned whatever is taxable for Social Security over $160,200, they do not take any more of that tax out of your pay if you're a W-2 employee, and it won't be calculated for your self-employment tax if you're self-employed. So there is somewhere where it actually stops. Unfortunately, that's still a rather hefty amount to contribute into your Social Security. And like I was mentioning, Medicare has actually no cap, so that just keeps going indefinitely. And that does open up opportunity for tax savings. And just note that not everything is taxable for Social Security. If you're an employee and you're on a W-2, certain things are not going to be taxable for Social Security, and some things will be. And that's why if you've ever looked at your W-2, you'll notice that box 1, 2, and 3 on your W-2 actually might, 1, 3, and 5. Those are wages for income is box 1. Box 3 is wages for Social Security, and your box 5 is going to be your wages for Medicare. And you'll probably notice if you have different types of fringe benefits that your 3 boxes, the 1, 3, and 5, might vary in amounts, and you might be scratching your head and asking yourself why. Well, that's because certain things are going to be exempt from income tax and certain things are not, and they'll be taxable for Social Security and Medicare, but not for the income. For example, 401k contributions. If you're contributing towards your 401k, that amount is actually excludable from your income taxes, your federal income tax, your state income tax, but it's still taxable for Social Security and Medicare. Additionally, when you're pulling out that money from your 401k, or in the future when you're retired and that money comes back in as income because it's skipped out on income tax, it will no longer be taxable for payroll tax, or what we call Social Security Medicare tax, or AKA FICA tax. All right. Okay, great. So now let's talk a little bit about how the self-employment tax actually works and the mechanics. I think it's important for everybody to understand exactly how this would look on their 1040. All right, so let's say, for example, you're basically self-employed and you have profits from business. Now again, profits is gross income, gross revenues, less your expenses from business, and then we're gonna arrive to a profit of $100,000. So here we are, we're sitting with $100,000 worth of profits. Now we're gonna calculate the self-employment tax the way it's calculated on your Form SE. So SE stands for self-employment, and that would be the form that should be completed as part of your 1040 federal filing. Just keep in mind that self-employment tax really is dealing with a federal level of taxation. This does not deal with a state or city level of taxation. So this is a very important thing to understand, because the way the tax laws work, there's always going to be differences between federal and state taxes, because what the IRS has as tax laws and regulations, states and local governments have a vastly different types of laws and regulations that will typically always vary. I'm not going to go into the intricacies of how that works, and let's just jump right back to how we're calculating the self-employment tax on a federal level. Again, IRS, whenever I say federal, I'm always referring to IRS tax laws and regulations. So here we are with $100,000 worth of profit. It's landing on your Form SE. It's being carried in from your Schedule C if you're a sole proprietor, but this can also apply to people that are in a partnership. Say, for example, a filing where you and somebody else is a partner, and then you're considered a partnership for tax purposes. And if you're, without getting into too much detail, if you're active in that partnership and that's, you know, your bread and butter, then the same rules apply. You're basically self-employed, and you will be paying self-employment taxes. It'll just flow in a little bit differently. It'll be coming from your Form 1065, which is a partnership filing. I'm not going to jump into that, and let's jump right back into how this is calculated now that you understand who it applies to. So 100,000 comes in either from your Schedule C or from your partnership, and now it's jumping to your Form SE, and now it's going to actually start calculating the self-employment tax. So fortunately, they do give you a small break. So the break is what I call a shave down. And if you pull up the Form SC, if you go on Google and type in Form SC, you'll actually be able to identify each line and see exactly what it's doing. And this is basically what the forms do. So they take the profit, they reduce it to 92.35%, and that's what I'm going to call the taxable base for self-employment tax. So now that we are at 92,350, now we're going to apply the self-employment tax at that 15.3%, and so that's going to come out to a self-employment tax of $14,130 if we're rounding up. So that's right, you heard me right. It's $14,130 you will be contributing along with your income taxes on a federal level. So if you're, let's say, in a 22% tax bracket and your income tax is, I don't know, let's just say $10,000, you would have to add that $10,000 of income tax to your self-employment tax. Okay, and this is what's actually going to leave the bank when you're paying Uncle Sam. So yeah, that's quite a bit of money. Now, there is a break for this self-employment tax, and it works much like as if you were just an employer of somebody, because remember what I said from the beginning. When you're an employer, you contribute 7.65% to match your employee's contribution towards the Social Security, Medicare, or let's just call it payroll tax, right? You're contributing. So as an employer, if I'm paying a tax, a payroll tax on behalf of my employee, I get a tax break. I get to write that off, right? So that's why you, as a self-employed individual, that still applies, because remember, you're being treated as employer and employee, so nothing really should technically change, and you should be allowed to write off 50% of that tax. So there is what we call a self-employment tax deduction, and it will reduce your total income for income tax purposes on your 1040, and that deduction is going to be $7,000 and let's just say $65 rounded up. So you are getting a deduction. The thing is that it's just a deduction. It's not helping you reduce your self-employment tax. It's only saving you 1% of your income tax. So again, back to my example, if you're in a 22% tax bracket, the $7,064 would save me 22%, right? So if I'm taking $7,065 and multiplying it by 0.22, that's going to save me only $1,500 in income taxes. So in my example before, when I said that if you have an income tax that's coming out to $10,000, and then we got to add it to the $14,130, well, then take that $10,000 and subtract out, let's say $1,500 just to make it easy, right? So actually it would be $8,500 plus the $14,130. So I hope everybody was able to kind of grab that, because I'm going through it kind of quickly. But in essence, this is what's saving you in income taxes. So your total tax is going to actually be less than $24,000. It would be $14,000 plus $8,500. And again, I'm rounding around and making things simpler. So it wouldn't be $24,000. It would be $22,500. And that's where the savings comes in. Okay, great. Now let's talk about double dipping of the Social Security tax. Well, you say to yourself, well, what does double dipping of Social Security tax means? Well, remember when I said that there's a cap of $160,200 in 2023 for how much Social Security taxes can be applied towards your wage base? Well, imagine, if you will, if you had, and this happens quite often, right? So if you're, let's say, a W-2 worker, and your wage base is $140,000 in 1 year, or rather, let's just say you've earned $140,000 in 1 year, and then you switch jobs and perhaps you make $250,000 or what have you, right? And now you're getting your second W-2, you switch jobs, they paid you $50,000. Guess how much you've earned? You've earned $190,000, and job number one does not know anything about job number two, so by law, they need to take out Social Security taxes and Medicare taxes from this job. And since they don't know anything about each other, when you get to your second job, then your employer is going to just take again the Social Security tax. So if there's a cap of 160, 200, and you've been taxed by Social Security for 190,000, they basically overtaxed you for Social Security because there is a cap. All right, so on your, where does that reconcile? Do you apply for a refund? Yes, you do, but it happens with your actual filing. So when you input your preliminary information into your tax return and you put in both of those W-2s, the software will know that you've been overtaxed for Social Security, so it'll actually give you a credit as if you paid in income taxes towards your total tax liability, and reduce your total tax liability on a federal side for the overpayment of Social Security. So in this particular case, you've overpaid by $29,800 worth of salary or wages. And so if we applied the Social Security tax rate of 6.2%, you would receive a refund on your tax return or as a credit towards your total tax liability of $1,848 if rounded up. So very similarly, if you're just getting into business and you go back to my example where you've profited $100,000, and let's say instead of coming from a W-2 job 1 and going to W-2 job 2, let's say for example you went into self-employment and earned $100,000 on top of this $140,000, it would work very much the same way where you wouldn't be overpaying. So the SE form is smart and would be able to pull that information from other sources and ensure that you're not being taxed again. All right, so that's a very important consideration in understanding how exactly that would work for years of transition. All right, so how do we reduce this self-employment tax, this dreaded tax that everybody keeps talking about? And obviously, I'm going to come down here and I'm going to spend probably the most time on number 2 because I think that this is an area that everybody really needs to kind of home in on and pay specific attention to. All right, so number 1 is obviously deductions. So what are deductions? Deductions, as defined by the IRS, are ordinary necessary expenses of conducting business. So if in my business, right, as an accountant, what is ordinary necessary as an expense? I have software, I have a desk, I have insurance. These are all examples of expenses that are ordinary and necessary for me to do business. So in other words, ordinary means that somebody else in my line of work also has similar expenses. They'll have insurance, they'll have maybe employees, maybe they'll have some transportation, depends, right? That's ordinary in the course of business, and it's necessary to conduct business. So that's the definition of a deduction. So if you have those and they're directly attached to your operations of activity, therefore they become deductions from your gross income, and that's basically how we're going to reduce the self-employment tax. But that's nothing really special. It's just kind of how it is. And just keep in mind, some deductions will not actually reduce self-employment tax. A great example of that would be health insurance. So if you're self-employed and you're paying towards health insurance, even though you're putting it through your business and it's actually, you're allowed to put it through your business and write it off on your business accounting, and the books and records would reflect it on your profit and loss as a deduction. For tax purposes, it's not actually reducing your self-employment tax, it would reduce your income tax and it would appear somewhere different. So again, just differences, subtle differences in tax laws, but primarily most of your deductions, I'd say a good 95% of your deductions are going to directly impact the income that will reduce your self-employment tax. Okay, so let's move on to number 2, and this is really the meat of the matter. And this is an area that I've spent a lot of time researching and guiding people over the course of many years. And it really kind of almost hurts me to see all the tax professionals out there today, and I'm not ranking on anybody, you know, we're all here just trying to help each other, but it's very common if you're on social media, if you're on Facebook or TikTok or Instagram, you're gonna see this, you're gonna run into this, and trust me when I say you've seen this 100 times. Everybody's always picking on the self-employment tax, and everybody's always saying, let's switch you to an S-Corp. If you're making $50,000 or more, we should switch you to an S-Corp. I've seen all sorts of numbers spit out there, and it's really very bland, and it's very bad advice and very generic advice, because unfortunately taxes are not that straightforward. There are so many considerations, guys, when it comes to entity selection and federal, state, and local tax law differences, that you could never just do such a blanket statement as saying, hey, if you're making over $50,000, let's switch you to an S-Corp and you're gonna save in self-employment tax, because that's just not that simple. There are a lot of other mechanics, and I've done some great videos that I'll link up here for you guys to check out and see what exactly I mean about entity selection and choosing the right entity for tax purposes, because it's really complicated. But in short, yes, you can definitely legitimately save a lot of money in self-employment taxes by just simply converting to an S corporation. Okay, so when you start out as a self-employed individual, you're probably either going to be set up as an LLC or a sole proprietor, right? Or like I mentioned, a partnership. And all of those types of entities can be converted to an S corp. So I'm going to write S corp here, S corp. And again, I've done many videos on this. And once you convert and elect to be taxed as an S corporation for tax purposes, you're actually changing the mechanics and the tax laws that will apply to your business going forward, and everything will be literally topsy-turvy. You will no longer be spitting out all that self-employment tax, but be very wary. Check out my other videos as to pitfalls, why not to do that, why not rush into something like that, and actually talk to somebody that has specialty in entity planning, because that is where people get tripped up. And I've seen in practice, besides looking on YouTubes and all that social media stuff, I've seen in practice many people come to us already with an S-Corp from another accountant, where they didn't really explain to them what they were doing. They just basically would hand them you know, the election forms, the 2553 form, and say, hey, you're just better off converting to an S-Corp, you're gonna save money in taxes, bye. But that's not really good advice. That's not really, that's doing a disservice to the client. In our practice, we wanna make sure that our clients are investing in their tax, because it's so important for them to understand where we're coming from and for them to understand what we're doing. We don't make blanket elections or push our clients into a different type of entity so that we can collect more fees, because that's typically what tends to happen. You know, if you're a Schedule C filer, like I mentioned, or a sole proprietor, your taxation is very simple. Everything's filed together on your 1040. There's no separate reporting. But when you pull something like an S-Corp election for your business, you're all of a sudden having a separate reporting. Formalities are now much more extensive for your business. It is no longer a simple form of doing business, and the accounting fees obviously go up. So again, I'm not ranking on other tax preparers or professionals, but we do see this happen quite often, where people come to us, they find their way to us, and I look at it and I'm like, yeah, well, they did this basically unnecessarily, and it's going to cost you more in money. So again, guys, yes, entity selection can definitely help you greatly minimize the self-employment tax, but it is a double-edged sword, and it needs to be done very carefully, and it has to be done with a lot of considerations in mind. All right, let's move on to number 3. And my partner Angie has done a great video right here as to how to minimize self-employment taxes when you're a partnership. And remember what I said, if you're a partnership and you're an active partner, which means that you're basically have, you know, a lot of dealings within this business. You're just another partner and you're involved, fully immersed, then the self-employment tax is going to apply to you. But that's not always the case, right? So there's sometimes passive, or what we call limited partners, that really don't have any managerial functions, do not partake in the daily operations, and so on and so forth. Again, Angie's video is going to go into much greater detail and explain exactly how you can set up the structure, so that way you're not accidentally bumped into self-employment tax by just being a passive, or what I call passive, or really a limited partner. All right, so this is a really great consideration, and her video is excellent. I highly recommend it for you guys to check out if that's your situation. And lastly, I put a little asterisk for number 4 because this is not really done on purpose, right? This is just happens to be. So if you're in a certain industries do not pay self-employment taxes because that's the law just looks at it favorably. I think an insurance agent is one of those. It's also a very specific insurance agent. I haven't seen that in a while, but everybody's probably seen one of those if they're a tax professional. And a notary is another example. If you're a notary public, then you're not going to be paying self-employment taxes because the law favors it, okay? As well, certain religious groups will also not partake in the Social Security and self-employment taxes because they basically elect out of it. I believe if you're Amish or maybe some other type of religion, just basically you're not going to get the benefits when you retire. Again, when you're paying Social Security and Medicare, and this is what I'd like to close off with, is because a lot of people get scared of this, right? But just keep in mind that, yes, it's a necessary evil. Do people argue and say, hey, why should I contribute to retirement forcefully, right? Why should I pay towards Social Security and Medicare? Because what if I can take that money and make it grow some other way? But this way I'm being forced by the government to pay in towards this retirement when I could do it on my own and probably get a much better rate of return on my investment, right? So that's the thing. But since it is the law, since we are left dealing with it as is, it is not really a choice. It is just a way we can strategize around it. But at the end of the day, we're all going to be forced into some level of I keep saying self-employment tax, into the Social Security Medicare tax system. And again, that system is there, which is designed to basically provide benefits for you in your retirement. All right, so the more you contribute into it, the more you're going to get back. It's not that black and white. Obviously, you know, there's certain high income earners don't want to over contribute, and that's why there's pensions and other tactics to not over contribute. So it's not like, hey, I want to make $1 million and give everything to Social Security and Medicare, and I'm going to then get so much more when I'm retiring. It doesn't work that way. It trickles off, and basically it doesn't matter after a certain point how much you're really putting into the system. You're not going to get that much more back out when you're in retirement. So that's really important consideration to note. So don't be super afraid of the self-employment tax, because you do need it, because when you are going to be in your older years, in your 60s, you're going to want to pull something out and get something every year. And that, depending on how much you've contributed, will obviously depend how much you're going to get back out in the future. And that could literally mean the difference between getting $15,000 in retirement per year versus, let's say, $30,000 in retirement per year. That's still all in future dollars, and it would all still add up towards your income when you're in retirement. All right, so other than that, I think that also it's a write-off, right? So if you're on the other side of things, it's a write-off, right? Remember I mentioned that you get 50% as a deduction, and that works the same if you're an SCorp, if you're a sole proprietor. You're basically getting to reduce your income, as I mentioned in the earlier part of my video, that you are still getting a write-off. So it does work on those levels, and it is a necessary evil, unfortunately. And we do want to minimize it, but we also want to maximize it at the same time, so that way we're finding a good balance. All right, guys. Well, thank you again for joining us on our segment, on our self-employment tax segment today. And remember, your success means our success here all day, every day. Thanks.